Hi guys, welcome to this next session of CFA Level 2 Portfolio Management. So far we've done the economics and investment markets and the very last trading of portfolio, which was a new addition to your syllabus, the trading cost and electronic markets. Today we'll be doing another new addition to the CFA syllabus, a very recent addition, the exchange traded funds. Now, this is also a new reading, and just like the reading of trading cost and electronic markets, most of the content here is fairly theoretical. If you have any sort of market experience, you have done investments, or you had any sort of job experience in the stock market or related to it, there is a very good chance most of what we'll be covering in this chapter you already know that. Now, for very basic understanding from an investor's perspective, an ETF can be thought of just like a mutual fund, which is traded on the stock exchange. So, a mutual fund which is listed on the stock exchange. But for you and me as professionals or as future professionals, it is very important to know how exactly the ETF functions. What are some of the dynamics of ETFs? So, we'll be looking at ETFs in slightly more detail. Now, I should let you know right away ETFs can vary from one country to the another based on whatever the regulations are. So what we'll be studying in this chapter may not 100% be true for your particular country as well. Your country's ETFs may change slightly on the basis of the regulations in place. So what's being provided by CF Institute in this chapter is a general outlook about the functioning of ETFs and some of the core things that we as professionals, as investment managers, portfolio managers of the future, something that we should keep in mind. So let's start right away with the first part, which is understanding the role of authorized participants. Now, the thing with ETFs is ETFs have gained a lot of popularity in the recent times. One of the main reasons why that has happened is if I want to invest in the market, so let's say I take an example of India, we have an index Sensex. If I want to invest in Sensex, I don't really have a way of investing directly in it. I'll have to use some sort of derivative instruments. And as a retail investor, not everyone is inclined to invest via derivatives. ETFs fill in that gap in the sense that ETF, I can buy the shares of this ETF, and the ETF is constructed in such a manner that it would track a particular benchmark index. So they have created this sort of an opportunity for investors that they can have exposure to the index returns without having to use any sort of derivatives. So normally investors are relatively familiar with how the equity share investing works. You buy a share of a company, the value increases, you have gains, and then you sell the share to realize the gains. That same mechanics have brought the ease of investing for the retail investor, but allowed them to invest in index. As such, ETFs, one of the biggest selling points of ETFs is they normally try to track a benchmark and they provide an investment opportunity to investors with their money could earn the return of that tracked benchmark. Now, in all of this, authorized participants or APs, they have a very significant role to play. Authorized participants and ETF, the transaction between these two, is sort of a primary market transaction. Just to recap, in case of stock market, primary market represents the first times the share is issued to the public. So an IPO could be a primary market operation. And then once the first initial issue has been done, after that the security trades in the secondary market where one investor could sell to another. Same thing happens with ETF and AP. The first time the shares of ETFs are created, the transaction is between ETF and EP. So this is the first transaction that creates the shares of ETF. What happens is I have ETF, and I have AP. In order to create shares of ETF, ETF should have some securities. So what would happen is AP in the market are normally your large brokers or dealers. So your bigger market participants. Now what happens is in order to create the ETF for the first time, to create the shares of ETF, AP would transfer a basket of securities. And in return, ETF will provide AP with the shares of ETF, shares or units, whatever comes you're more familiar with. Now, what has happened is AP, because it's a large broker dealer, they already have a stock of lot of securities. They might have some shares of telecom companies, some shares of aviation, some shares in chemicals. So they have a large stock of shares or any securities that they already own. All they are doing is they are transferring those securities to ETF, and in return they are getting shares of ETF. Now, this entire process is known as creation of ETF shares. This is the creation process. And this basket of securities, the set of securities that AP gives to ETF, this is known as creation basket. Now, APs have a very significant role in the sense that APs have the responsibility or they have the power to create more shares of ETF and also to redeem the shares of ETF. So, in essence, APs are responsible for creating liquidity in the market for ETFs. So, if they think the liquidity in the market, so let's say the demand in the market for now, if they think the demand in the market is very high, they might give more securities, make more shares, and then these shares that the AP have, they sell it in the market. So just like an equity share, let's say I bought shares of a company in an IPO. That's a primary market operations. But after that, I can sell it to any other investor. That's secondary market. Same thing happens here. AP gets the shares in a primary market operation. But after that, AP can sell these shares to the public. So AP has the right, the power to create more shares of ETF. So if he wants more shares in the market, demand is very high, they want more shares in the market, he can give more securities to the ETF and create more shares. Similarly, if AP believes that the market has very less demand, he might want to take away some of the shares from the market. That taking away of some of the shares is known as redemption. So first process is creation, the second process is redemption. In redemption, AP would return the shares of ETF back. So if you have any sort of confusion, think of redemption as buyback for equity shares. A company lists, that's known as creation, IPO. A company might repurchase its shares, that is buyback. This is sort of the same thing. The only difference is this time it's not the company who is doing all of this. The responsibility for initiating this transaction lies with the AP. But the transaction is same thing. I'm just returning shares, and in return, ETF would give me again a basket of securities. Now, this basket of securities is known as redemption basket. So far, I hope it's all making sense. We have authorized participant AP. The responsibility of AP is to maintain liquidity in the market for the shares or for the units of ETF. How do they do that? Well, they have the power for creation and redemption. So if they believe liquidity is high, demand is very high, they might create more shares. If they believe demand is low, they might redeem some of the shares. Now, in this entire process, this is basically the only new part. Like if you have any sort of market experience, you probably already know how rest of the thing works. Once this is done, EP has all of these shares. EP will sell these shares to the investors, and that's how the ETF market that we know as investors starts. After that, one investor can sell to another, and it's the standard trading in the market that follows. The only part relevant was this initial part. Now, in all of this, there is some benefits to having this particular structure. So if you notice carefully, the transaction between AP and ETF, both creation and redemption, at no point have they exchanged cash. Both the transactions are in kind. One security is going and the other security is being received. In redemption also, shares are being transferred and a basket of securities is being returned. Now, this process of in-kind creation and redemption, which means no cash is involved in creation or redemption of shares of ETF. This has certain benefits. Now, these benefits are very important. You could easily get theoretical questions, which are the following is least likely a benefit of in-kind creation redemption of ETF. So, all of those are relevant. Let's look at those. But before that, some of you might have a doubt as to what would be the securities in creation basket, redemption basket. Well, any sort of security that the ETF wants to invest in. So let's say ETF is trying to track Sensex. I would give them some of the equity shares of the companies which are there in Sensex. Similarly, redemption basket, this won't just be a random set of securities. Generally, the securities which would be provided when the redemption happens would be agreed upon between the AP and ETF in a preemptive manner. So they would already have an idea as to which securities are to be given to the AP in case a redemption happens. And same thing goes for creation basket also. They would have a general idea, the ETF would have a general idea of the securities AP would give if he wants to create more shares. So these are just set of securities. It depends on what ETF is tracking. The securities would generally be similar to that. So I hope all of this makes sense. Now let's look at the benefits of in-kind creation and redemption. So we have three benefits of this in-kind creation redemption process. First is of course lower cost. In the market you often have to pay brokerages, transaction fees, all of those things. But if I have an in-kind transfer, I could save on some of the brokerage charges. I could save on some of the processing fees that otherwise might be charged. So I can have lower cost in comparison to other transactions. Then you could have tax benefits. Now, normally what happens is in any sort of process where I am getting shares or am I selling shares, the tax incidence happens by the way of capital gain. So if I buy shares of a company and then I sell it, I have some gain. That gain is known as capital gain. Now, normally capital gain is charged when you realize it. So let's say I bought shares of Reliance for 1500 rupees. I sold them for 2000. That gain of 500, I'll have to pay tax on that on the day in which I sell the shares of Reliance. So that's when the tax becomes due. In this particular case, because the creation redemption is both in kind, I'm not realizing the gains. For example, AP might have transferred the basket of securities. For a moment, let's assume the securities in creation basket and redemption basket are identical. There's no difference. When the AP had the creation basket, when he gave the creation basket to the ETF, the value of all the securities was 1000 rupees. And when he received it back, the value of these securities is 1200. This 200 is his gain, but he hasn't realized it in cash. It is still unrealized gain. Tax is always charged on realized gain, not on the unrealized gain. So what he would have in that case is, well, this 1200, he won't have to pay tax immediately. Rather, this 200 will be taxed when these securities are sold.